Hey, this is Brian Heller. If you want to learn how to use your small axe to build an empire, you should be listening to the Small Axe Podcast with my good friend Nico.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys.
All right. Hey, Small Axe community. It is your boy, your best friend, Nico. Today I'm hanging out with a guy named Brian Heller. We met a few years ago, Brian, and we hit it off right away. We were in the same network, same group of people, and I'm really excited to get him on today. I want him to share a little bit about his journey. He's going to talk a little bit about how we can kind of make correlations between what's going on today and in the past, and we're going to project a little bit into the future. But before we get there, let me get him on the show. Brian, welcome to the show.
Awesome, Nico. Thanks so much for having me.
Cool. I'm excited to speak with you. Now, before we jump into it, Brian, could you give us a little bit of context about how you got to where you are today? Just take a few minutes to shed some light on that.
Absolutely. So, born and raised in California, grew up in the Bay Area, ultimately moved to Southern California, the Los Angeles area, to go to USC, where I graduated in cinema television. Ultimately worked in the entertainment industry for a little over 10 years. You can see back here, I've got my Survivor torch. I did 5 seasons of that show. I worked on shows like The Bachelor, Ripley's Believe It or Not, Secret Millionaire, and a bunch of others we won't mention here today. But really rewarding experience. Got to do some amazing things, travel the world, blow up mountains, all sorts of cool stuff. But ultimately, decided that it wasn't building too much of a future, and the travel and everything was pretty demanding. So ultimately decided to get into real estate at rock bottom of kind of the last cycle in March of 2010. I was an apartment broker in the greater Los Angeles area for a little over 8 years, doing over 200 million in transactions, mostly call it 10 to 100 units, primarily for small syndicators and other value add investors. I was also an on-site manager for one of my clients, managing a 30-unit building right off the Sunset Strip. So that was a great opportunity to see the day in and day outs of building operations and watch as they value added the property over the course of the 6 or so years that my wife and I did that. Ultimately decided, though, I wanted to get out of brokerage and more onto the principal side of the business. So moved to Nashville a little over 7 years ago now. Since being here, I've done everything from building houses to entitling land that we ultimately sold to one of the 7 largest home builders in the country to do a 200 unit plus townhome and single family development. Have been an asset manager for one of the nation's premier iBuyers, and have also done one apartment syndication where we went full cycle. We purchased the property in 2019 and ultimately sold the property in June of 2022, having executed our 10-year business plan in a little over 2.5 years. So we decided it was a great opportunity to take the chips off the table and return very solid returns in capital to our investors, delivering a 40 IRR and a 2.43x. So everyone involved in that was very happy. We were very pleased with our overall execution of the business plan, and since then have been actively working as an apartment syndicator and capital raiser full time. But obviously, since June of 2022, the market's been pretty difficult environment, and so finding that next opportunity has proven difficult. Nashville has been voted by ULI as the #1 real estate market in the world the past 3 years. So it's become an incredibly competitive environment, and has allowed sellers to not necessarily adjust their pricing expectations as quickly as I would have hoped. But not only do I look here in the Nashville area and about 4 hours circle from here, including Louisville, Knoxville, Chattanooga, down to Birmingham, Huntsville, and all the way to Atlanta, but also looking with other high growth at other high growth markets with strategic operators such as Houston, Denver, Kansas City, North Carolina areas. So, really excited about finding some new opportunities here in the near future, and yeah.
Brian, you have a more extensive background than I realized. So really, really refreshing to hear all that. And we could literally take any one of those roles and positions and make a full episode about it. But let's focus. It's crazy. It's wild. You have a really good background. So let's talk a little bit
Thank
about
you.
what are you most passionate about today in all of the roles that you have done? And I'm yeah, let's start there. Where are you most comfortable and passionate?
I'm most passionate and excited about being on the principal side of the business. So, apartment syndication and capital raising. So I'm primarily focused on acquiring my own deals. Like I said, here in the Greater Nashville area, I currently about to go under contract on 60 units just outside Kansas City, and am also trying to grow my business by doing some capital raising for selective operators that have incredibly strong track records in high growth markets, so that I can allow my investors to have more consistent deal flow and opportunities, and access to more markets where we have got strong boots on the ground partners and people with really attractive opportunities nationwide.
Awesome. Now, let's say the 60 unit, you do get it under contract. What will be your main role throughout the whole period?
I guess in essence, I would obviously be heavily involved in investor relations, capital raising, and then the asset management side of things. The partner that I'm working with on this deal, he would be the boots on the ground, but he has a strong background in construction management and owns several construction companies. So he'll really be helping to manage the value add, the turns of the units and things like that, because he's able to get really good costs on the products, and it has a really good system in place. I'll be working with the management and overseeing probably the entire business plan, and then obviously communicating with the investors that we bring on board.
Excellent. So let's talk a little bit about your that success story with the purchase in 2019, I believe, through COVID, and sold it for a 2 point something equity multiple. Sounds insane.
Yeah, so that property worked out really well. So that property was here in Nashville, really in a town called Gallatin, a small, I shouldn't say small, I mean 35,000 and growing at this point, but B plus class suburb, about 25 minutes outside of Nashville. Facebook's about to put a huge data plant there to give you kind of a background on its growth story, but really right down the fairway kind of opportunity, right? In that owned by a mom and pop owner, but a gentleman whose family did own a significant amount of real estate. But I do think that this property for them was really one of their smaller assets, and they had owned it for so long that they were, absolutely happy collecting checks and just making a ton of money. So great but the property was still 25 plus years old. So our opportunity was to come in and do a really really standard value add approach, and starting with painting the exterior of the brick, working class kind of looking brick white, putting on a new roof, like I said, 25-year-old roof, so it definitely needed that. Generally cleaning up the exterior of the property, turning 14 units over the course of our ownership, standard value add upgrades, hardwood floors, stainless appliances, new countertops, lighting fixtures, etc. The real interesting thing on this property, and something that I'm very proud of, is so we bought it in 2019, and obviously COVID hits in 2020, so we had only owned the property for a few months, before the entire world changed, and a lot of people trying to figure out what to do. Obviously, we had had a plan to turn X amount of units per month and things like that, and ultimately it proved much more beneficial not only to the tenant base but to our investors and the financial business plan of the property, to try and keep as many people as possible, but to push rents as close to market as we could without ultimately having to renovate them. and that strategy worked really, really well. In addition to just having a good tenant base and good management, ultimately we never had anybody not pay. We hit all of our distributions to our investors, and I think we had one group that we had to put on a payment plan for 2 or 3 months, but everything worked really, really smoothly. And like I said, ultimately through cap rate compression, on top of just the amount that rents grew here in the Nashville area and the quality unit mix, we were able to get an amazing all cash offer from a 1031 buyer out of California, and it just made a lot of sense to take the chips off the table and move forward.
That's awesome, Brian. Was it listed or did the 1031 buyer approach you or how did that happen?
We ultimately listed the property. Yeah, my partner and I are both brokers, and so in this case, we decided to list the property ourselves.
Cool. And so aside from the challenges with that COVID provided, I mean, were there any, like, did you guys have fixed rate debt on it? I know today is a little different story. People are going in with a lot of bridge debt. What was the debt like on that one?
Wow, you hit the money question there. So, yes, we did have fixed rate debt, but if you wanted me to help educate your listening audience here, I would argue that's actually the one mistake that we made. Now, the reason why mistake's probably even the wrong word, but yeah, we had agency debt on this property because ultimately we were expecting to hold the property 5 to 7 years, a typical lifestyle. No one was expecting the dramatic, price increases that COVID created. And so as a result, our initial plan was to have the agency debt and then do a supplemental. But I'm not sure how much you know about this, but during COVID, supplementals basically went away, or if they were going to give you the money back, they would ultimately hold the funds in a reserve account, which meant you couldn't actually return it to your investors. So it really, the way we were looking to sort of refinance or get some cash out of the deal sort of became an impossibility as a result of COVID and COVID reserves. So in the end, it it became a detriment. Now, obviously, the interest rate was great, and the fixed nature, all of that was very, very positive. But we actually ended up paying a very large prepayment penalty because of the fact that that interest rates had actually gone up, um, since we purchased it. And so the good news is we had made so much profit on the deal that it really didn't matter. But as a learning experience, it probably would have, if we had been on maybe shorter term debt, or something with a credit union, or local bank. I think back to my LA days. Like in LA, there Chase it was a lot. Almost everyone on their first loan, if they were doing value add, did Chase, and then if they, because they just had such great short term terms with no um, prepayment penalties, right? Well, the one issue with agency is you have yield maintenance, which is incredibly daunting if you ultimately need to sell early. And because we had gotten a 10-year agency loan, so we had a very large prepayment penalty. But again, I go back to the fact, like I said, the property made so much money and we did so well that we were able to take $100,000 or so hit on the prepayment penalty. But it obviously would have been nice to put that in our pocket as well. But you live and you learn. And again, the only reason why our debt strategy wasn't as successful was because of COVID and these restrictions and covenants that no one could have ever predicted in a million years. So,
Yeah. Thank you for sharing. It's hard to really like we go in with a business plan, but it's loose, right? And things change, market shifts, and that business plan has to change as well. And sometimes you need to sell early, but it's hard to like we there's a trade-off. You go with agency and you get better rate in terms, right? But then there is the prepayment, and sometimes that's the best strategy if you know that you're going to hold it for a long time. But even if you do know, sometimes you still want to sell it. Bill Ham tells a story. I don't know if you remember, but he lost $1 million with a prepayment penalty on a similar situation. But again, it was still also worth it for him to sell and take that hit. But that's a tough pill to swallow sometimes.
Yeah, it absolutely is. I've talked with Bill. He's one of my coaches as well, and yeah, I mean, we've joked about it, but if you did that good and you can take that hit, then it is what it is, and all you can do is make the best decisions possible. I would argue that we needed that debt to purchase the property in order to compete and beat out 17 other offers that we did to get the property. So, again, the big factor that caused all of these issues was COVID, which just, like I said, couldn't have been controlled or foreseen. So,
Right. All right, Brian, we're going to transition a little bit to talk about today and how you see, or because you've identified some similarities between today and 2010. Perhaps you can kind of elaborate a little bit.
absolutely. So yeah, started in the industry in 2010, and so I have sort of a unique perspective. Obviously, I started in brokerage then, as opposed to the syndication and principal side of things. But as a broker, those are the people you're reaching out to, right? So in terms of market environment, there was, in that case, the recession was already full-fledged and going for quite some time, but obviously due to the mortgage crisis, but there's lots of pressure on the Federal Reserve to lower interest rates, general uncertainty about when the market might stabilize, incredibly low transaction velocity, lots of people leaving the real estate industry, difficulty getting financing. This was much more difficult in 2010. Right now you can get financing. You may or may not like the terms, but then it was very difficult. So a lot of creative financing going on for deals. Most buyers were on the sidelines, a real pencils down environment, wait and see, herd mentality amongst most of the buyers. The bid ask spread was wide, and buyers and sellers were really struggling to find valuations very similar to today. And I think if you asked most people, they would say that at that time they probably felt it was about 6 to 18 months before the market would sort of truly get back to normal, right? But if we're looking back in hindsight, it was very clearly the birth of a new cycle, and those who did buy and were able to find transactions that hit their buy box and stick to their guns and that made sense were very happy over the next 5, 7, 10 years. um, it sounds crazy to think back, but at this time you could get B and C class properties in Los Angeles at a 6 and a 7 cap rate, and some of the older vintage 1900 singles buildings in Hollywood and Koreatown and downtown for $50,000 a door. And now I'm guessing those are trading at $200,000 plus per door. So and even over the course of the cycle, I mean, when I was still there, they had gotten to 150. So I mean, that's a triple right there. And that was 2015, 2016. So like I said, 5, 6, 7 years later, you've got a real home run there on your hands. So those are some of the main correlations that I see, and it also is what has me really excited. Nobody knows exactly how many interest rate cuts and stuff we're going to have this year, and I'm certainly not proposing to go and buy everything that you can, but if you can find those opportunities right now that do hit your acquisition criteria, I think you'll find financing out there at this point that will make sense. And if you can put together a good business plan, I think that it's better to be aggressive than to be fearful right now, and to take those opportunities, so long as you're not forcing it or anything like that. So
Yeah, I agree 100%. I don't have the experience from that time period. I was I was focused on teaching. However, I did buy in 2012 a couple of things. I bought my primary residence, and I also bought a piece of land, which everything has really gone way up since then. But I'm in the same camp as you. I think that today's an excellent time to take advantage of what's going on, as long as, just as you said, we stick to our criteria, right? So we all should have our criteria laid out for us. We should have, our metrics that we and our targets that we want to hit. We should have our deal criteria specifically stated, written down, and rehearsed, and stick to that. we now is not the time to stray away and kind of like pencil whip a deal, as Bill Ham would say, and to just to make it work. Now's the time to stick to your guns and make sure it works, because come a few years from now, if rates do go down, we'll be in a really good spot.
100% agree.
Yeah. So talk to me a little bit about what you think you like. Are you aggressive for 2024, where you're still looking at, I'm assuming, the same markets you mentioned, looking with operators that have experience and good track records? What is your overall sentiment for 2024? And do you have like a goal set?
Yeah, so let's we'll unpack that in two phases. So the first question was, sorry, what do I anticipate for 2024?
Yeah.
So I think 2024 like I says, is going to be a great year of opportunity. I think certain markets, buyers and sellers still have quite a bit of a spread to overcome, like here in Nashville. But I think that there are some markets where you're going to start to see opportunity. Some markets are going to see more distress than others. While there's going to be a wave of distress from those that use floating rate debt, I don't anticipate someone like myself getting a lot of those opportunities. We've already seen the BlackRocks of the world, tend to scoop those up in very large tranches, and I don't think as many mom and pop investors are necessarily distressed. I think it's some of the larger transactions. Now, there may be a few out there, but and I do think that that will help to set a little bit of a floor, and maybe give some more price discovery to both sides of the market. But my goal this year is to add 100+ units on the general partnership side, and potentially some more via being a capital raiser, which would still to some degree be on the GP side, but not necessarily with full voting.
Awesome. And so you have experience looking at deals to partner with people that are experienced operators, and this is key and crucial for my listeners. When you're vetting an operator, what do you go through? Like, what's the thought process? Are there some key things that we should be listening to from you or looking at when we're speaking with new operators potentially to invest with?
Yeah, I mean, obviously you want to be looking at an operator's track record. You probably want to know again that there's a boots on the ground person on the team. You want to look at their entire team and who's involved. Um, Another thing that I think is really important is looking at the fees that they're charging in their deal. I see a lot of people putting in incredibly high fees for them, which tells me that they're pretty much just motivated on that, not necessarily motivated on the deal. Making sure that the operator has some of their own skin in the game. I mean, that's a really big thing. And any deal that I'm going to do and bring my investors into, whether it's my own deal or if I'm raising capital for someone else, I'm positive I'm going to be putting in some of my own money so that they know that I'm standing right next to them, to handle any risks and any rewards, and that I have full confidence in the deal. I'm not just bringing it to them so that I can collect a fee or anything like that. So those are probably some really simple and quick important things to be looking for. I
Awesome.
mean, I guess the other thing, obviously, where you can go back to location, and product type, and then is the deal hitting your standard metrics, and do your kind of core values or what you're looking for in the investment align with that person, right? If you might be looking for cash flow, you might be looking for appreciation, you might be looking for a 3-year turnaround with some return of capital. You might be fine with a preferred equity collecting just a check and not necessarily have as much of the upside. So everyone's needs are different, but yeah, it's obviously important to vet the operators.
Yeah, awesome advice, man. So me personally, I'm in the gaining equity in a deal, at the stage of my career, of my journey. And down the road, though, once I have a lot of equity, I will reinvest it and go for like the pref equity, right? So with a higher return, and hopefully that capital will be producing a return for me that I can live off of or sustain myself with. Um, you, a question came up the other day. A newer investor was asking, it was on one of the webinars, it might have been a Jake and Gina one, and a newer investor was asking, how do you ask, like, yeah, we want the track record of these operators, and how do you get that track record?
Well, I think it can be several different ways, right? I know you see a lot of people out there with high assets under management numbers and things like that, but I don't think that necessarily speaks to all of it, right? Because I think people put out really high numbers, but they don't really they own two bathrooms of a $200 million AUM, right? As sometimes I joke, and that's not everybody, obviously, but I think that you want to look at general experience, the overall team. Like I said, are there combined? Do you have the right people you need in the right areas? What has this? What makes me unique is I've seen the industry from every single angle, right? I've been on the brokerage side, I've been on the management side, I've been on the principal side. So even though I maybe have only done a few deals that I technically owned, I've been a part of business plans and executing them and helping people develop them for over, close to 800 units in one of the premier markets in the world, right? So I think you got to look at everything. I think you want to connect with the person on a like I said, on their values and on their timeline of what they're looking to deliver. So
Yeah, great advice. I also recommend, uh, if the operator is open to it, asking them if you can speak with some of their LPs or their previous LPs on other deals. That kind of gives a good, obviously it could be biased, right? They could just give you the best LPs, but it's also good to kind of hear their perspective and pick their brain as well.
yeah, I mean, I don't disagree with that, but I would argue that a lot of the big investors, don't necessarily want to be bothered and very much so want their privacy, right? So that's a little bit invasive and not necessarily my favorite tactic, but I do obviously have investor testimonials and things like that on my website, and if someone requested it, I would do my best to do that for them. But I think too, I mean, I don't know, I'm a really good judge of character, and usually just hearing someone kind of talk and walk me through the property and seeing the level of materials and stuff they're producing and are their projections and stuff accurate, usually would give me a pretty good idea as if they know what they're doing or not.
Yeah, excellent point. I didn't even think you could have. I have testimonials also, so I think maybe that's the way to go instead of invading people's privacy. I like that thought process as well. Awesome, Brian. Okay, let's transition a little bit. Let's imagine this is going to be our final question. Let's imagine it was 100 years from now. Now you have great grandchildren and they're running around and they're super happy. They were watching old episodes and reruns of Survivor, and they wanted to write a book about you to honor you and your legacy. What would you want them to title this book?
Well, the way things are going, Survivor will still be on when they're there miraculously, but I guess that goes to show what a great show and formula they have. But no, great question. I think it'd be great if they would call the book Gratitude, and I think that's something that's just it's so important. Oftentimes people take for granted, and some of us are we've been very fortunate in our lives to have a place to live, have food, clean water, safe homes. We can go shopping, we get to go to football games, and we get to work in real estate and own these amazing assets and improve communities, make clean, safe, affordable places for people to live, and help investors create financial freedom. And so if they could just have gratitude and be grateful and remember me and reflect on how lucky they are based off of hopefully the portfolio I've created, the knowledge I've passed on to them, then that would be pretty awesome.
Brian. That is so cool. Gratitude is a huge topic with me. Even this morning, I was thinking about it. That somebody brought up AAA, which is a different AAA, not the car stuff. So it was like acknowledge, accept, and appreciate. And it goes back to a lot of times we have these visions of grandeur, or we're seeing somebody else as being in a better position than us, but it's also a good reminder to just acknowledge what we have, to accept, and then to appreciate everything that we have, because gratitude brings us joy. If we can feel that emotion of gratitude, we will always feel joyful and happy. So I love it, Brian. Thank you.
Yeah.
Let's give the listeners some form of contacting you.
Absolutely. So it's a little weird here. I'm in the process of a rebrand right now. So if you needed to go somewhere today, I'd go to brianhellerinvestments.com. That being said, that site is more from my brokerage days and has almost become a little bit more of a digital resume, but there is a great case study on there from the first deal that I mentioned. If some of your new listeners wanted to go and check that out, there's before and after photos and things like that. But any day now, I'm going to be rebranding under Fairway Equities, and that'll be at fairwayequities.com. So yeah, I look forward to if anyone has any questions, feel free to reach out. Right now, my email is brian@brianhellerinvestments.com. Would more than happy to answer any questions, or if you have some interest in being an LP investor, reach out and let's set up a call, and hopefully we can help each other out.
Awesome, Brian. Thank you so much for sharing that info. And I'm excited to have gotten you on air finally and to hear your story a little bit more and learn a little bit more about you. I really enjoyed how you correlated today to 2010. And I think that it shows that there's going to be a lot of opportunity. So we all need to stay bullish in this market. And I appreciate you. And let's keep chatting offline.
All right. Thanks so much.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.